Welcome back to the Deep Dive. We're here to cut through the corporate jargon and give you the core insights you need, nice and fast. Today, we are definitely undertaking a critical mission. It's a deep dive into the Q3 2025 earnings call and, well, the full financials for Restaurant Brands International. RBI.
Yeah, RBI, the
Well,
big one. Parent company of Tim Hortons, Burger King, Popeyes, and Firehouse Subs. Quite the portfolio.
Exactly. So our goal today is really to unpack where their strategic focus is, where that capital is going, which brands are, firing in all cylinders, and maybe most importantly, how they're handling this complex global QSR landscape.
And QSR, quick service restaurant, that's key here. Because honestly, the consolidated numbers, they show some remarkable resilience across those different brands. For Q3 2025, RBI reported system-wide sales growth up 6.9%.
Okay.
And maybe even more impressively, comparable sales actually accelerated, up to 4.0%.
Acceleration is good.
Yeah. And then if you look a bit deeper, the bottom line stuff, organic adjusted operating income AOI, that grew 8.8%. Management sounded, well, very confident. They confirmed they expect to hit at least 8% organic AOI growth for the full year 2025.
At least 8%.
Okay. But what's really fascinating, I think, is what's driving that confidence. They stated pretty clearly that 70% of that AOI comes from just two places: the rock-solid Tim Hortons Canada and their entire international business segment.
Wow, 70%.
Yeah.
That figure immediately sets up, well, the core tension for us, doesn't it? I mean, if almost 3/4 of your profit engine is running smoothly in Canada and internationally, it suggests the other 30%, mainly the U.S. brands perhaps, involves more heavy lifting, turnarounds, volatility.
Yeah.
Does this focus on Canada and global expansion mean their U.S. brands are maybe lagging, or is it just smart risk management?
Honestly, I think it's probably a bit of both. It definitely reflects the maturity and just sheer consistency of Tim Hortons. We really have to start there, right? It accounts for a huge 44% of their operating profit. Tim Hortons Canada is just, it's their financial fortress.
It really is a machine, isn't it?
Yeah.
Tim Hortons Canada, 4.2% comparable sales growth in Q3. That's a strong number on its own, but the context really matters. They're consistently beating the wider Canadian QSR industry.
Yeah, by about 3 full percentage points, which is significant outperformance.
Well, that's huge.
And consistency is absolutely the word. Tim Hortons Canada plus the international segment, they've now hit 18 consecutive quarters of positive same-store sales.
18.
18, that's what, 4.5 years? Just relentless execution no matter what the market's doing.
Okay, let's unpack how they do that. Because 18 quarters isn't just luck. The reports point to clear leadership in certain areas, right?
Yeah.
Especially breakfast. Grew 6.5%. And they made a point of highlighting that shift to the 100% Canadian freshly cracked scrambled egg platform. That feels like an important signal,
Right.
Quality, sourcing, maybe justifies better pricing and builds loyalty.
It absolutely reinforces that breakfast dominance, and that strength then lets them focus on the next big opportunity, the PM day part, afternoon, evening. You see it with successful seasonal things like the Thanksgiving stack they mentioned,
Right.
but also disciplined everyday value like those $8.99 dinner deals after 5 p.m. That seems to be working.
And the beverage story sounds really good, too. Total beverage sales up 4%.
Yeah,
But the kicker is cold beverages grew 10%.
10%. Yeah, that's the interesting part.
We talk a lot about QSRs trying to grab that high-margin cold coffee business, sort of like Starbucks. Tim Hortons seems to actually be succeeding here.
Driven by things like improved iced lattes, new protein lattes. It's smart.
Yeah, because expanding that cold category, it boosts the average check,
Yeah.
right? Yeah. And helps smooth out those volume dips outside the morning rush.
Definitely. And operationally, they're hitting records. Guest satisfaction, all-time high, speed of service, fastest Q3 level since 2019.
Wow.
And that operational discipline, that's the engine that makes those new PM offers actually profitable. If you're fast, you get the order right, that $8.99 meal feels like great value.
Makes sense.
Plus, they're investing back into the restaurants. They're on track for kiosks in about 800 locations by the end of the year.
Kiosks are interesting, not just efficiency, right? They tend to drive higher check.
Exactly. Suggestive selling works on screens. And looking even longer term, they announced this huge new loyalty partnership with Canadian Tire. That launches late 2026, but connecting Tim Hortons regulars to a massive national retailer that could really expand their loyalty reach. Huge potential there.
Okay, quite the powerhouse in Canada. Let's pivot now from the Canadian core to the ongoing U.S. turnaround story. Burger King U.S. It's a smaller slice, about 17% of operating profit, but still critical. We've heard about the Reclaim the Flame plan for ages now. Is it actually working? Is it leading to lasting change?
Well, it is showing consistent progress, and I think that's what you look for in a multi-year turnaround like this. BKUS delivered 3.2% comparable sales growth in Q3. And crucially, they are consistently outperforming the overall burger QSR category.
Which is super competitive.
Extremely competitive. But maybe the metric that really proves the turnaround is gaining traction is this shift in guest perception. Their tracking shows revisit intent, basically. Does a guest trust the brand enough to come back?
Right. Key metric.
It now ranks in the top 3 out of 12 major QSR brands. That's a massive swing from where they were.
Top 3. Okay, that's significant.
Yeah, it really shows guests are noticing the quality improvements, the operational fixes from Reclaim the Flame.
And that focus on intent, on trust, that feels much more valuable long-term than just, heavy discounting. I also like that they seem to be sticking to the playbook. Lean is the icon, the Whopper. They highlighted the Whopper by You platform, things like the barbecue brisket Whopper, the crispy onion one.
Right, localized variations.
Yeah, it's smart. Reinforces the core, but still offers something new.
And they are being very disciplined on value. That's critical right now. They seem to be avoiding those sort of short-term, aggressive price wars, instead focusing on strategic platforms like the $5 duos, the $7 trios.
Building long-term value perception, not just quick traffic spikes.
That seems to be the goal, a disciplined value strategy, as they call it.
And the investment seems to be paying off physically, too, those Royal Reset remodels.
Yeah, the remodeled restaurants are delivering strong uplift. They said in the teens, net of control groups.
Wow, teens is strong uplift.
And average post-remodel sales are jumping significantly, often hitting around $2 million annually.
Okay.
Even the Carroll's units, the ones RBI bought back and now runs in that RH segment, saw impressive 4.8% comp sales growth under the new Sizzle image.
So progress, definitely. But
Yeah.
there's always a but, isn't there?
There is a big one here. Beef costs. They are a severe headwind right now. We're talking beef prices up high teens % year to date in 2025.
High teens. Ouch.
Yeah. And given beef is like 25% of the BK U.S. commodity basket, that inflation is really squeezing franchisee margins.
Okay, wait. RBI called this temporary, right?
Yeah.
Tied to the U.S. herd rebuilding cycle.
It did frame it that way, yes.
But from the franchisee's point of view, the ones struggling with margins right now, how long can they really stick to that disciplined value strategy? Doesn't something have to give, either costs elsewhere or raising prices more aggressively? This feels like a major tension point.
It's the critical risk, absolutely.
Because if franchisees lose confidence because their margins are tanking, the whole turnaround could stall, couldn't it?
Exactly. RBI needs them investing in remodels, in operations. Inflation makes that much harder. Management's optimism, publicly anyway, suggests they're focused on finding efficiencies, managing the supply chain to bridge this gap. They're betting prices will normalize maybe in 2026. But for now, it seems they're prioritizing that value perception over, say, short-term margin relief for the operators. Hoping the sales lift from remodels and the Whopper stuff compensates enough, it's a balancing act.
It's a tricky one. Okay, let's shift gears to where things seem much smoother. International. That's driving 26% of the AOI. We saw accelerating performance there this quarter, right?
Absolutely. The international segment really picked up steam, 6.5% the same-store sales growth and 12.1% system-wide sales growth in Q3. And it's not just one market carrying the load. It seems to be a pretty powerful global movement across the board.
This is where having that global footprint really pays off, I guess. Burger King UK hitting over $1 billion in system-wide sales. It's a massive milestone.
Huge, hard-won market.
And Popeyes International seems to be on fire, growing system-wide sales over 35%.
Yeah, Popeyes International is performing exceptionally well. Management even claimed it now ranks among the world's top 10 Western QSR brands outside the U.S.
Top 10 globally, wow.
The scaling is, frankly, breathtaking. Turkey, for example. They expect to hit nearly 500 locations this year. That shows incredible local adoption.
500 in Turkey, that's amazing.
And the UK, they're opening their 100th Popeyes in November. That's just 4 years after launching there.
4 years to 100 restaurants. That's aggressive.
It really showcases that the Popeyes product, that core offering, translates incredibly well globally.
Okay, but let's touch on Burger King China quickly.
Yeah.
Because that seems contradictory. RBI got a controlling stake earlier in 2025, but then immediately marked it held for sale. Discontinued operations.
Right.
Why sell off a business that just posted 10.5% comparable sales growth in Q3? Seems odd.
It does seem odd on the surface, but it raises a bigger point about RBI's overall strategy, I think. The core plan seems to be simplification, getting back to a nearly 100% franchised, capital light model.
Oh, okay. Asset light.
Exactly. They see BK China as high potential, definitely, but they seem to believe its long-term success needs focused local management and capital investment that maybe doesn't fit RBI's central strategy right now. So they're actively looking for a new local controlling shareholder, someone to manage it on the ground, which fits that capital light approach.
Okay, that makes more sense in context. And that simplification goal, that
Yeah.
also applies domestically to refranchising those Carroll's units they bought, right?
Precisely. They expect to refranchise a huge number, 5,100 restaurants in 2025.
5,100.
Yeah. And interestingly, it's not just selling big blocks to private equity. About half are going through this unique Crown Your Career program.
Crown Your Career. Tell us about that.
So from what I understand, it's designed to build a pipeline of new, really top-tier manager operators who eventually take ownership themselves. The actual deconsolidation, taking them off RBI's books, happens gradually over 1 to 3 years as these candidates graduate the program.
Interesting model.
Yeah, it seems like a smart way to transition ownership responsibly, keep operations stable.
Okay, let's wrap up with the last two segments. A bit of a mixed bag here. Starting with the growth story. Firehouse Subs, FHS.
Right. Firehouse Subs is really showing some impressive momentum, proving RBI's acquisition and growth model can work. They hit 10.7% system-wide sales growth, and maybe more importantly, net restaurant growth was 7.7%.
Unit growth is key.
Definitely. They opened 100 net new restaurants in the last 12 months. That's apparently 5 times the growth pace compared to before RBI acquired them.
5 times. Okay, that investment in development is clearly paying off.
Handsomely, it seems.
But then, in stark contrast, we have Popeyes.
Yeah.
But in the the U.S. domestic comparable sales were actually down 2.0% in Q3.
Down 2.0%? Yeah.
So they're losing ground in their home market. What's the diagnosis there from management? What went wrong?
Well, management was very clear. They are not satisfied.
Yeah.
Absolutely not. They figured the main cause was a shift in focus. Too many limited time offers, or LTOs.
The LTO trap.
Kind of. They saw things like the dippers drove high initial trial, people came in once, but they didn't generate enough repeat visits. And LTOs often complicate kitchen operations, right? Can slow down service.
Right, so the fix is simplification,
Okay.
which seems to be the theme elsewhere.
Precisely. Sounds familiar, doesn't it? The new plan is to pivot resources back to the core stuff. Bone-in chicken, tenders, the sandwich platforms, and alongside that, aggressively improve the overall guest experience. Simplify operations, prioritize getting needed equipment upgrades into the restaurants.
Back to basics.
Pretty much. And they're also getting stricter about who opens new units, focusing only on their top-performing operators going forward. Confidence apparently remains high, though, mainly because the core product quality is still seen as excellent, slowly marinated, hand-battered chicken.
True, the product is generally well regarded.
And the asset base is relatively modern. About half the system opened in just the last decade, so they have the infrastructure. Now it's about executing the fundamentals flawlessly.
Okay, so bringing it all together, what does this mean for you, the learner? Looking at this huge global company, what's the main takeaway here?
Well, if you connect all the dots, I think RBI is effectively showing that disciplined, really high-quality execution in its core, mature segments, Tim Hortons International, and now the early stages of the BKUS turnaround that strength, is successfully offsetting some localized pressures. And it's offsetting the underperforming segments, like Popeyes US at the moment. The overall financial foundation seems to be getting stronger through that strategic simplification we talked about. You see it in things like lower net interest expense, and they cut segment G&A costs by $8 million just in Q3.
Right. That overarching strategy of simplification, getting out of owning restaurants directly, like with Carroll's and BK China, is clearly about managing risk, focusing capital where it gets the best return. But for me, the most powerful takeaway here might be the sheer focus on operations. In both Tim Hortons and Burger King, those small incremental improvements, speed of service, getting orders right, guest satisfaction, those were called out as critical drivers of perceived value. They're improving the experience, not just relying on deep price cuts. It proves that operational excellence, not just flashy marketing, is really the engine of competitive advantage in QSR.
Well said. Execution matters.
Which brings us neatly to our final provocative thought for you to chew on. Given that ongoing pressure from beef costs hitting the high teens, squeezing franchise profits in the US RBI has staked its Burger King turnaround on maintaining that disciplined value strategy.
Yeah.
How long can they realistically stick to that playbook? prioritizing long-term sales lift over maybe more immediate margin support for franchisees. Before that, commodity inflation forces a significant, maybe even damaging, shift in their core strategy. Something to think about.